This is the Market Edge Tuesday Tech Talk, and we're going to look at a few of the different indexes today and see if we can try to figure out what's going on with the market here over the next couple of days. So let's go down here to the market letter. Okay. All right. Last week we had a positive week, and it was the second straight week that the Dow was up. The major indexes were up a little bit. Technical condition of the market improved somewhat, but most of the technical indicators are still neutral. Momentum's flat. We're still not seeing any positive follow through after we get a positive day. We went up Monday and Tuesday, and then we sold off the rest of the week. Earnings, for the most part, have come in better than expected, which most investors were hoping would provide a catalyst for the major averages to break out of their trading range, move a little bit higher. But unfortunately, as we see the yield of the 10-year Treasury nudge towards 3%, we're not getting that catalyst to go higher. In fact, one of the reasons, this is a good point of why technical analysis is just as important as fundamental analysis. If you were just listening to the fundamental analysts, you'd be looking at earnings coming in at 20% this quarter and thinking we'd be in a boom for the market. As it is, the Dow Jones and the S&P 500 are both down year to date against that backdrop. So we have a minus 10 on the CTI. That's the cyclical trend index, which points that there's still weakness in the market. That will probably stay bearish for another week or two. The most glaring thing that I see that the CTI is picking up is that a weak technical chart pattern is where you have lower highs and lower lows, and we're in the process of doing that with both the Dow and the S&P 500. We'll take a look at those charts in a little bit. Okay, we had the momentum index actually moved up a notch last week. Momentum is positive on our momentum index, and that means that the other indexes are outperforming the Dow. Part of the reason we see that is because you're seeing more of some profit taking in big cap stocks, and the Russell 2000 and some of the other indexes are actually outperforming the Dow. So that's why we have a bullish on the momentum index. However, the momentum indicators on the different charting packages are all pretty much neutral. Sentiment was unchanged last week at 0. Just about everything is neutral. We have a couple bullish sentiment readings. That's basically the yield spread, which is still quite low, is bullish. And as far as what we see on the strength indexes, they were all a little bit higher last week too. They actually had big jumps, which means we're still under accumulation. We're not seeing much any panic selling in this market yet. I suspect if we go above 3%, especially about 3.1, that will probably induce some more selling. As far as the counter technical events last week, we saw 2 of the major moving averages turn down. That was the 21-day and the 50-day. So we are starting to get a little bit of a rollover here. We had a little bit of a few bullish indicators come up, or technical events came up, but now we're starting to roll over again. As far as the industry groups go, we're about split, improving and strong, and weak and deteriorating. We're about 43 strong versus 48 weak. Strongest groups were metals, non-ferrous, semiconductors, paper products, and oil secondary. The semiconductors and related, remember the relative strength is over a 50-day period, and over the last 5 days, semiconductors down about 7%. So I would take that with a grain of salt. In fact, it's possible that if you look at the SOX, the Philadelphia Semiconductor Index, you'll see that we're breaking down on that thing, and it's possible the semiconductors have actually reached their peak already for this cycle. The weakest are retailers, drug-based, marine transportation, tobacco, and home furnishings. Let's go take a look at the Dow real quickly, see if we can pick up any hints on what its plans to do. Go up to the charts and put in DJ I-30. Okay, you're seeing this kind of sideways pattern going on, but what's important is that if you draw a trend line from this high and you come down through here, you can see that we actually, uh, this downward trend line has served as good resistance for a while. Now, over this last week, we fell below the 50-day and the 100-day moving average. And today we're down about 150 points as the 10-year Treasury did cross above 3%. You can see that this is the 21-day, but we went below this today. This is the 50. So we went below that. That's the 21. We went below that end of 50, and we're below the 100 also for the Dow Jones. I'm going to switch this up so we can see the 100-day moving average. And make this as simple also. There we go. So you can see over here, yesterday or the last couple of days, we've fallen back below that 50 and 100-day moving average. Okay, let's take a look at the S&P 500. Put in SP-500. And here you have the same thing. You have this, lower highs, lower lows coming back up here. We're starting to roll over again. And that's a bearish pattern. Descending trend line going back on this again. Has served as resistance. That's probably going to stay there for a little bit. You see down here on the indicators, this is right at 49, so that's neutral. And until that's below the 50 and 100-day moving average there. I would imagine if the selling picks up with the yields moving on up, we'll go down here and at least test this 200-day moving average again. Now here's the NASDAQ next. Oops. Going to put a COMP, and you'll hit it. Now, this has a little bit of a different pattern, and it's actually kind of a scary chart. And the reason I say that is because here's where we had our first pullback back here in February. And the NASDAQ was the only index that actually went on to rebound and make a new high. So if you take a look at this, this is what could possibly be forming a head and shoulders pattern. I don't think it's going to happen, but if we could come down here and break below this 200-day moving average, you would say here's the one shoulder, there's the head, here's the other shoulder that we're in the process of forming. So if we break below around 60, if we break below this 200-day moving average, which is around 6,800, that's going to open the door for a move back to this September lows over here around 6,300, which will be back in this area. So if we see all three of the major indexes break below that, you're going to need to be on the defensive a little bit, because that's not a good sign. And that head and shoulders pattern would get 6,300. Okay, the last index we want to look at real quickly is the Russell 2000, which has been outperforming. You just kind of see a little bit of a triangle pattern starting to form here. There's some of these in here. Coming up through here. But Russell has been outperforming a little bit. Part of that reason is because small caps are the biggest benefactor to tax cuts. We're still trading above the 50-day moving average and the 100-day moving average on the Russell. Although with today's losses, we could be getting close. I'm not sure where we are right at the moment. Okay. Anyway, if you're looking to buy anything on here right now, as far as the sectors go, you only have a few of them that are either outperforming the broader market or at least even. And if I was going to look for a place where I would at least want to move into the market, it's probably going to be, we talked about this back in February and March. Hopefully you got into it in there about the energy stocks and how oil was probably in the process of heading towards $70 a barrel. Now we've had this broad basing pattern in XLE, which is the energy sector, and now we've had a breakout here over the last about 2 or 3 weeks ago, where we're breaking up to this part. Now if you take all this and you take a Fibonacci retracement from the top here to this bottoming part, you can see that right now we've already retraced about 62% of this thing. Usually when you do that, you're probably going to go up to about, retrace the whole thing. So as we get oil closer to $70, you're going to probably see this, go on up a little bit higher. Now, the bad part about this is most of these stocks you should have been buying over in this period when we were talking about this before. So I'd be hesitant to chase them too much because they've all had some pretty good moves in here over the last 2 weeks. But if you go into the industry group and you look at relative strength, you'll see that the top performing sectors are oil field drilling, oil secondary, oil integrated majors. And you go on from there, and it's going to go in. If you click on one of these things, let's go to the secondary. And you look in here, you'll get a list of all the stocks that make up that group. And as you can see, they're all long with a score of 0. So you pass over this, you can look at the charts, and you can see this, the almost parabolic moves on all these stocks. We were right on the button back here in February and March to get in here. I hope you got in there, because right now, what I would do with these, if you bought back then, is and you see oil, which probably will go over 70 here very shortly, maybe in the next week or two. A lot of it's geopolitical tensions. Trump and Iran also getting riled up, could push it above 70. We get to around 71, 72. If we come back and trade below, say 69, I would lighten up on some of those positions. But hold on for right now, because I think there's always a possibility we could go up to 75 or higher on this. Okay, one of the other sectors that still looks good. I'll go over here and look at the charts again. It's XLF, and that's the financial sector. We're talking about buying these on pullbacks, and you got a little bit of a pullback here, in March. Brought us back down here to the 200-day moving average, and now we're starting to see that these move up again. You're up again today, and these are up here going to probably break through your 50 and 100-day moving average. As interest rates rise, that's good for the banking stocks, and you're probably going to see these things. I've noticed you're getting some upgrades as far as price targets go. And we'll look at actually one of the banks here on our doc stocks here in just a little bit. So anyway, those are the two places that you probably want to be looking to add in here. The energy and oil stocks, I don't know if I'd be chasing because they've had such a parabolic move, but I think you can still add some positions in here in the financials for the longer term. Now, with that said, what we talked about as far as the deteriorating chart patterns on the broader indexes, I still think as the rates go up, the broader market could still get a little bit of a pullback in here, but any pullback on the financials you want to pick up. All right, each week we do something called doc stocks. I want to take a look at real quick since we're talking about the banks. Last week we did something on U.S. Bancorp. Go on the home page, you can pull these up. And what we do is we take some stocks that are in the news. In this case, Barron's did a feature on U.S. Bancorp, issued an outperform rating with a $61 price target. Last week it was at 51.41. We had an avoid on it, but they were raising the stock's price target on that. So you take a look at that. We're going to go with a second opinion. In this case, most of the indicators are still bearish, but I think you're probably in the process of turning around a little bit. Okay. Now you get on here, look at the chart. You can see where you've had this pullback down here. Most of the technical events were bearish, but you found this bottoming pattern down here, which also we hit back in looks like maybe around September. Okay, we came down, tested that low, and now we're starting to stair step our way up a little bit higher. You're starting to see some increasing momentum. The CHO oscillator is still showing it's kind of neutral, not seeing a lot of accumulation yet, but you're starting to see, like again here also in the MACD short-term trend, you're seeing some positive results in that. The stock has bounced off that bottom around 51, and that $61 is probably a pretty good price target if the rates keep going up. Okay, we'll also take a summary on all these stocks when we do them. And it says the technical condition for Bancorp remains weak, with 9 of the last 11 events since the beginning of February being bearish. Okay, in addition, the stock had a point figure triple bottom breakout back here in March. But we did, with this bounce, we did see a little bit of improvement with the MACD turning bullish. So what you would probably want to do is if you put this into one of your stock watch lists, wait until our market edge opinion goes to a neutral early entry buy, or wait until a long position, and then I would start to nibble away on those. All right, that's about it for this week. Again, we're going to stay negative for at least another week or two. And if you have any questions during the week, you can send some emails in to support@marketedge.com, and we'll try to get them up here and review some individual stocks. Have a good week.